And I just kept reading and listening to podcasts and everything. And I came across this thing called syndication, which frankly I'd never heard of before, at least not in this capacity. And it kind of blew my mind. And so I thought, yeah, I can buy, how long will it take me to buy 100 single family houses versus one 100 unit apartment building? And sort of, so the ability to scale faster was very appealing to me.
Everyone to the show. We're joined today by our trusted colleague, Rebecca. How are we doing, Bex?
I'm good, thank you.
Always a pleasure to have you back on. And Jason Ballara. Jason is the CEO and co-founder of Lark Capital. Jay, thanks so much for coming on today. I know I did your show a couple of weeks back, or at this point, it may be a few months back. So it's always a pleasure to reconnect, and thanks for taking the time today.
Yeah, no, I appreciate you having me on. And yeah, I think probably it has been a couple months. The time goes by so fast. But yeah, but no, thank you for having me. I appreciate it.
So Doc, as I will refer to him for the rest of the show, Doc is a veterinary, and he has found a really interesting niche, I think, in the market, and he's doing investing now through Lark Capital, which I guess the idea is you're targeting folks in your world, in your universe. Is that how this is working?
Yeah, that's my idea. We don't, I wouldn't turn away investors that are not in the veterinary community, but there was talk about, sort of finding your avatar that you're aiming towards. And I also think that in the veterinary community, not that a lot of people get a lot of financial training, but we don't. We go to school for a long time, and ultimately, vets get very wrapped up in kind of just functioning in their day-to-day work, right? Just I gotta help as many animals as I possibly can without having any business sense, without really thinking, I think a lot of times just about their own financial future. And so and that was me, like, basically all of my life until sort of recently. And I decided that it was just you can only work so much, right? And so it was kind of figuring out a way out of that. But my goal as part of it, as part of my journey, is to help other veterinarians kind of reach financial freedom as well.
So you touched on something that we're really taking a deep dive on now, financial literacy, where we have book club here at the office, and currently we're doing Rich Dad Poor Dad. And I think it's certainly not just vets, right? I think that across the spectrum, like for whatever reason, and it wasn't obvious, right, until we got halfway through the book, but then it became like so obvious that financial literacy, it's just not part of any core curriculum, it feels, and it's just absent from the discussion, across the spectrum.
Yeah, I think I mentioned that in our last book club. I said, I don't understand why we're not teaching this, in high school. And James was like, yeah, even college, we're not learning this. And it's such important stuff.
Right. No, totally agree. And a big part of it, like I said, is helping vets and helping them gain financial freedom. But also I'm a big, very passionate about the power of time. And so, of course, I want to sort of impart this stuff on my kids, but also, like you said, the high school, college age people, you can get started with a lot less at a younger age than if you pick it up in your 40s, like I have, where it's like, I just feel like I'm a lot of times playing catch up in terms of trying to get to that, goal of whatever you want as passive income. So it's kind of the younger generation, I think, it'll be really important for us to kind of, and with social media and things like that, it's a lot easier, right? We can put things out like your podcast, and there's so many ways to get it out there now.
So I folks, I think it's really important we spend a minute here and talk about what's kind of at the core of what Doc is doing there at Lark Capital. And you had said time is the most valuable commodity, right? And you had talked about you don't want to be in a vet or in any practice forever. I think most of us share those sentiments, but we don't understand the trap of trading time for money, right? And this is something that we didn't really start to focus on until the last couple of years is when it really started to take center stage for us as we kind of climb the ranks in our local market and we're getting involved in bigger projects. And with that comes better and more stronger consulting contracts, if you will, right? But those contracts, which are great, because if you're in our business, it's feast or famine, right? It almost feels like it doesn't matter how much success you've had in real estate. There's just that's the ebb and flow in the nature of the business. So the consulting contracts become a great way to have just that steady cash flow that, is coming in every month, but you fall into the trap of trading time for money. And I would assume in your position, right, there's only so many surgeries you can perform a day. There's only so many animals that you can see throughout the course of whatever the office hours are for the day, week, month, or year. And you really are kind of bound by that and what the market will allow you to charge. Was that some of what was at the genesis of you making this transition?
Yeah, I mean, it's a funny, quick little story that I've told people before is that, now I'm talking about, hey, you need a retirement plan. These are the things you can do to kind of set yourself up for the future. Well, within 5 years ago, my retirement plan was don't retire. Like that's literally it was like, I like working. I'll just keep working. I didn't have a plan for it. And so it's when I talk to people about this stuff, I'm like, look, I've made every one of the mistakes. I've done it all wrong, but now I figured it out. And listen, this is this is very doable for everybody. And so, yeah, but I got into that, trading time for money sort of hamster wheel where it was just, I learned to work hard at a very young age. I worked for my uncle. I've basically always had jobs that were in some way production based. Even when I worked for him, he paid me by the day. So if I got my work done faster, I had more time at the end of the day, effectively making more per hour, right? So I've always had that sort of thing, and even with being most veterinarians, there's some level of like production compensation with it, and you probably would be hard pressed to find a more efficient surgeon than me. And I'm not saying that to like boast or anything. I'm saying that to say it doesn't matter. At the end of the day, I can only do so many surgeries in a day, whether that's patient-based or my technical staff or whatever it is. So I feel like I have maxed out what I can actually do in a day in terms of surgery and still be doing a good product, right? Like I want to make sure that every one of my patients does well. That's first and foremost. So at some point you're just cutting corners and rushing, and I have no interest in doing that. But I got on that, so I got on that hamster wheel, and it wasn't until I had my son that I realized I can't do that forever, or I can, but I'll miss out on everything with him.
So folks don't often make the connection, and sometimes candidly, there's a negative connotation associated with being a real estate agent or being a realtor. And for us, it's just been the gatekeeper to all of this other opportunity, right? And when you're in this business, and you're trading what in most cases is the highest priced asset someone's going to have in their portfolio, you are not bound by that trading time for money model as much as you would be in a production style environment, right? So there's an opportunity to, from the sales side, really perform exceptionally well. And then if you're trying to pull it all together and you're seeing the big picture, the idea is to graduate into investments and to start building your own portfolio. So for us, it's a natural progression, right? We're in it, we're around it, we're very familiar with the market, the terms, we understand what's a good deal and what's not a good deal. I'm really curious, how did you make that leap? Because it feels like a leap, right? Going from being a vet to B and C class multifamily investing. What was that journey like for you?
Yeah. So what I sort of isn't really in my bio is before I went to vet school, I worked in construction a lot. So I have a construction background before, during vet school. After I've done a number of like single family flips and things like that, and I've worked for contractors. I worked for an electrician. The house we live in right now, like we gutted it to the studs, and I did almost everything myself. Like I can build a house, right? So my thought was always, I've always loved it. I've always loved construction. Uh, like yourselves, I'm from the Northeast. When I was sort of deciding sticking with construction or going to vet school, honestly, the weather had a lot to do with it. I didn't want to be outside in the winter, up on roofs. Right, because that's what I associated with it at that time, because that's what I had been doing. I was the guy that carried the shingles up the ladder and that stuff. So that's what I associated real estate and construction with, not being on sort of like the development side of it where you're just the one orchestrating everything, right? And so I have that background in construction. When we sort of reached the point where we finished up our current house, we had our son, actually not in that order. Then I was like, oh, I have some time, which is silly to say. It's like I have some extra time. Maybe now it's time to get into investing in real estate. Sort of get back to it. I had always done it as basically my own houses. I owned a 3-family in Boston at one point, like little stuff. So I started looking into. I live in Los Angeles, so it's very hard to cash flow almost anything, right? Like it's hard to buy something here, as I'm sure it is in New York as well. Like there's the costs are hard. And so buying something here to rent it didn't really make sense financially. I would happily flip here in Los Angeles because I think you can make a lot of money that way. But again, it's just adding another job. And so I started to do some research, listening to podcasts, reading books. And first I started out where I was going to do long distance burrs, basically on single family. And it just so happens I had a friend who used to work here with me, moved to Georgia, to Atlanta, and became a realtor. And so I was like, Georgia's a good market. I'll talk to her. And so essentially made that connection. I actually had kind of everything in place to do it on a single family basis, to do rentals on a single family basis. And I just kept reading and listening to podcasts and everything. And I came across this thing called syndication, which frankly, I had never heard of before, at least not in this capacity. And it kind of blew my mind. And so I thought, yeah, I can buy, how long will it take me to buy 100 single family houses versus one 100 unit apartment building? And so the ability to scale faster was very appealing to me. I like the idea of long distance because I think if I get something here in LA, I won't be able to keep my hands off it. Like it will become another job because that's just kind of the way I am. So the long distance thing is good. But I mean, I think that's kind of making a short story long. That's how I made that, sort of transition. So it wasn't crazy that I would think about real estate or construction or any of that. Like the asset management side of multifamily ownership is actually what's most exciting to me because I understand construction, right? So I can go there, walk these properties, and I can look around and know what needs to be done. I know how to, sort of, if a bid sounds crazy, you know what I mean? Like I can speak that language. So it makes sense to me to do that asset management. So that's kind of, like I said, in the journey, that I went through to kind of get to that point of looking at multifamily deals.
So you covered a lot of ground there, and just for the audience's benefit, when Doc is talking about it's hard to make something cash flow, yet you can do flips in a market like LA, and we experience this here in New York quite a bit. The barrier to entry in these bigger cities oftentimes is just so astronomically high that it's very difficult to rationalize putting the significant amount of capital toward a transaction that you have to lay out, right? Your cash on cashes here are usually very, very challenging. and while your rents are great, in most cases, the purchase price is also extremely inflated, at least as compared to the rest of the country. So when you're doing the fix and flips, right, when you're finding an asset, and you're, for whatever it needs, you're going in, you're adding a second floor, or you're rehabbing it, or you're doing whatever you're doing because of those higher purchase prices. And now where you've got super low interest rates, there's a lot of buying power out there. There's a lot of cash out there. I found it's a great place, these markets, to get the seed money together, right? To build the experience and to churn a book and to do, as many as it is that you think you need to do to get into that next level. But this is a good place. These types of markets are great to get your feet under you and build up that bank of cash, if you will, so that you can then go and leverage it in other markets. So what markets are you investing in, or are you targeting now from the multifamily perspective?
Yeah, mainly Georgia, Atlanta specifically, and the Carolinas. My wife's from Charlotte, North Carolina, so I know that area pretty well. Excuse me, sorry. We lived in Charleston, South Carolina for a while, so I know that market as well. So there's some parts of the Carolinas that I would love to invest in, but so far I've been working in Atlanta mostly.
And you're in like Center City, or are you on the outskirts of Atlanta, or are you like out in the surrounding counties?
More outskirts. I think the surrounding counties can be great, but I think right now Atlanta's experiencing such a boom that if you can get that sort of path of progress just outside of Center City right now, those are great deals, and you'll have cash flow because the prices are low enough, but you also have the opportunity for appreciation in a relatively short period of time. So it's kind of almost like a twofold play on that location. If you went to the more outer markets in Georgia, I think you'll still get a lot of cash flow, but probably not quite the appreciation you would get if you can stay right around Atlanta.
So I think Doc is being very friendly in what he's describing there. So I think, not I think, we're at a point where we really feel very strongly about what's happening in these tertiary markets, right? We're seeing primary markets that are always challenging to break into. So what happens in a hot market is these secondary markets emerge, right? And there's a lot of damage to be done in the secondary market. But now we're seeing people go to these tertiary markets, right? So when you start getting further and further away from Center City and you start playing around the outer, the outskirts of the outer rim, if you will, of the target area, that's where you can get hurt when the music stops, right? Folks tend to migrate towards Center City because of the job opportunities that are there. And if you're going to be playing in the rental world, you need to make sure that you're at least somewhat centrally located to the employment base if you want to make sure that those apartments are going to be filling up in good markets and bad, right? So I appreciate the way you phrase that. And, but we're seeing people that are doing really good in these tertiary markets now. But for the most part, I've been through 2-3 cycles at this point. We know what it looks like on the other side of this coin. And we're just cautioning our listeners, be smart about, don't buy payments, right? There's a lot of folks that are just straight up buying payments. There's low interest rates, and they're not keeping an eye on when those notes mature, because in most cases, they're not amortizing over a 15-year term, certainly not a 30-year term. And they feel like, well, at that point, the apartments are rented and the cash flow is coming in, and I could just refinance, right? And usually when you get to that point, you're faced with much higher interest rates, right? Inflation, I think, is without question coming. I think it's here, but I think it's coming in a much more meaningful way. And you could be you'd be surprised how fast the music stops in this industry. Like, it's shocking how quickly the real estate market turns. So I think that's really sound advice and sound strategy that you're deploying there. How are you sourcing these deals? Do you have boots on the ground there, or?
I don't specifically have boots on the ground at this point. I do know some people in Atlanta, like I mentioned, my realtor friend. I've met through networking some other people that are syndicating in Georgia. And at this point, what I've done is I've just been, sort of making those broker relationships myself. I've gone to Atlanta a number of times. And so I've actually made relationships with property managers. So the funny thing is that the property manager thing is actually what turned out to really help me, because I had, anybody who's out there listening and they're like, oh, I want to get into this. If you read a book about it, you listen, sort of follow the directions. They're going to tell you need to make relationships with brokers. You need to make relationships with property managers. So you have that in place. So when you find a deal, those things are kind of, already there for you. So I actually worked a lot on that. I mean, that was probably a good 9 or 10 months of really just working on relationships, looking at deals, over all marketed deals. When you're starting out, nobody is likely going to give you the off market deal that's super hot. It's just not how it generally happens right now. And so I looked at a lot of deals. I made relationships with a property management group. They would look at, they would go for me to tour the properties. Initially, they would send me videos, pictures, tell me what they thought about it. We got some offers in on a couple. And so developed that relationship. And then it was actually the property manager was talking to a deal that was coming online to a broker who I actually hadn't met at that point, and was like, hey, this would be a great one for Jason. So it was true. It got marketed. I didn't get that off market, but it came through those relationships. So we actually got to look at it like before it officially went on market. And then through that, when I went to look at that deal, I said, hey, what, you have anything to the broker, anything else around here that you think we should look at? And he's like, yeah, we have this other one down the street that is actually an off market deal that we're working on as well. So we're potentially going to have, we have the one under contract. We may potentially have two. So it's those relationships, and everybody says it, right? It's like, and I think even myself, I'm not sure that I believed the importance at the beginning, but it really, once you see it start to work, it's pretty incredible.
That's so true. So for somebody who might be thinking like, okay, I want to invest in this other market, and you said that you were networking and making relationships, how did you go about that? Did you do it via like social media, or was it from going to visit and, finding local brokers and property managers?
Yeah, it was mostly phone calls and emails for me, because I started this during COVID. And so as much as I would have loved to be traveling more when I was starting this process, I know people did. But at the time, my wife was pregnant. Now we have a 4-month-old. And so there was always, and my toddler's not vaccinated. So there's just always this stuff in our minds that it was like, as much as I want to do this and make this work, I'm not willing to put them at risk. And so it was kind of, I always had that in the back of my mind. Once the vaccine rolled out, then had more comfort level. So most of it in the beginning was phone calls and emails, just kind of getting to know people and just underwriting a lot of deals and talking to the brokers about them. So it's an exercise in persistence, I guess, at first.
Absolutely.
Just, well, this, and the thing is, you're going to, and everybody says this too, but you're going to underwrite. Most of them are going to look bad. Like, you're going to underwrite them. And most of the time you're going to be like, it can't possibly sell for that. Right. And then it does. And you feel like you're doing something wrong. But like, the reality is, as you mentioned, people like, syndication's really hot right now, and people want to get in. And so people are willing to overpay because the market's been so hot, and they're like, well, this is just going to continue. I'll really be able to ride that tide, but maybe not, right? Maybe it will keep going up. I hope so. But maybe there's going to come a time where things, pull back, and we're all gonna, you don't want to get stuck, right? You don't want to, we talked about sort of the avatar and me, looking to do this and have vets as investors. My reputation in the veterinary world is probably way more important to me than my reputation in real estate world right now. And if I'm going to bring in a bunch of vets, essentially a group of people that will be solely trusting me in terms of, because it's not something that generally we all know about. They're trusting me. If I lose their money, like I'm done on both sides, right? Like then I can't do real estate, and not that you can't, but I mean, you know what I'm saying? Like it damages those relationships, and I don't want that. So I've been very conservative in terms of the underwriting, and I like the markets like Atlanta and Charlotte, and they're a little bit hotter and more competitive. And as you mentioned, sure, I could go to, sort of the middle of nowhere and probably get something at a lower base, but I also won't feel as confident that we're going to be able to implement the value add program that we want to.
So you're deploying a ground and pound process, right? Of identifying the boots on the ground that you're going to have to rely on once you take down a property. So that is as sound fundamentally as it gets, folks. The people don't understand the importance of having the right, even above the brokers, and I'm a broker by trade, is having the right asset managers and property managers on the ground for a myriad of reasons. But one of which is they also have access to those deals many times before they hit the market, and they typically know every single rub about that asset, right? They know more about that asset than we can ever dare to know on the investment side. So that's about as sound fundamentally as I've heard from a strategy absent being there. I know there's a lot of networking and folks are doing it on social media, which is also certainly a pathway. Look, Doc, the music is going to stop. It always does, right? But that's okay, right? When the music stops, that doesn't mean that the deals stop. They change, right? And the metrics change. But if you're positioned properly, we've found always you could make far more money in a challenging market than you can in a hot market like this, because all of that competition that we're talking about, it kind of goes away. Right. And real estate loses its luster a little bit. And for a couple of years, people really step back. And when they do that, it creates a vacuum and there's opportunity. So you reference on your site, and you've mentioned a few times today that you have a value add model, right? You're seeking Class B and Class C multifamilies that are value add plays. Could you speak a little bit more about, what is your investment criteria and what does that value add play mean to you?
Yeah. So, I mean, in terms of investment criteria, as you mentioned, B and C class, which for the most part has to do with vintage and location, right? Or like if people don't know, I mean, the year that it was built essentially and where it's located, right? So you have the class of the asset, and then you have the class of the neighborhood essentially. And so part of the reason for that sort of asset class strategy is because those are potentially the more affordable properties to take, right? Like an A-class property is going to be probably outside of my comfort zone at this point in terms of like capital raising and things like that. The other thing is that, as I mentioned, construction's my background. So I don't go into these places that need a lot of work and think, oh man, I see opportunity, right? I see current ownership there's a lot of deferred maintenance. They haven't kept up on it. I see this is how we can improve these properties to not only increase rents and increase NOI, but make the lives of the tenants better, right? So it's kind of, to me, those are the opportunities. And I don't think I'm alone in that. I think that's generally the value add strategy. You go in and fix up the interiors, make sure you've got all of the exteriors, so that it shows well, right? You don't want your tenants or prospective buyers in the future and you're trying to exit. You don't want people to drive into that property and go, nobody's done anything here for the last 5 years, right? But I do. When I go there and I see that, I'm like, that's opportunity. So that's just kind of the way I look at it. And I think that comes from, thankfully my wife tolerates this, but she knows I won't buy a house that's already done. She just knows at this point, because I if I didn't do it and I didn't know it was done right, then I have a hard time, sort of accepting someone else's cosmetic reno. So I think that that same kind of mentality works for me in the multifamily space.
And could you talk a little bit about deal size? What from a price point perspective and a unit count perspective, what are you targeting now?
Yeah, so I mean, I'm targeting probably around 100 units, and I would say that probably goes, 70 to 140, 150 would probably be the area. The interesting thing is when I started this process, I got a mentor. And I've heard other people say this, it wasn't just my mentor, but people talk about you can't make them work as well unless you get over 100 units, right? That was kind of that's a big thing that people talk about. And so when I started, I thought I had to look at 100 units to 250 units. It's like, okay, it's got to be this big, or there's no point. And that's actually where the property management relationships came in. So I had been talking to another property management group who I was referred to, and they're fantastic. I have nothing bad to say about them, but they won't do anything less than 100 units. And so then it's daunting to think about the amount of capital you have to raise on like a $40 million, $50 million deal. It's just, the numbers get sort of scary. And I'm sure for experienced people, that's not the case. They see that as, they've already got a list of investors and things like that. So when I started looking at the numbers and what I would have to raise from capital, and that's mainly what deterred me and made me think maybe I should look at some of these smaller ones. So then I started, when I would ask the original property management group about, what they thought about say a 70 unit, they're like, oh, that's too small for us. So I just started asking around who does those, who manages those properties in the Atlanta MSA. Came across, I was introduced to Meridian Property Management Group, and they've just been fantastic. And they'll do those smaller ones, but still do it at a cost efficient level. So it just goes back to that. You just need to have the right people on your team. It doesn't, because I'm not there, right? I'm not going to manage it myself. That's probably good. Like, it's just, they're going to know, and the feedback and the ideas that they've given us just in terms of what to do with this value add strategy, that you said before, they know the assets well, they know the market well, right? And then they know everybody, they know all the contractors, they know who's going to charge a lot, but it'll be licensed work. They know who's going to do it for really cheap if you just need, something easy done. Like, they already have all of those relationships, which would take me years to do that if I was going to do that myself. So running the asset management through the management group in the area that I'm so sort of fond of them and what they've already done for me, that my strategy now is when I pick another market, it's going to be where they are, right? I'm going to say, okay, where are you guys located? Where are you managing properties? I already know sort of that they are managing properties in areas that I like in the Southeast. So it's an easy match, but it's kind of like that just gives me, I already have that relationship. So trying to start in a new market from scratch will be a lot harder than starting a new market and already having at least the management group in place.
And your is the fund set up where you're identifying a deal, tying the deal up, going and sourcing the capital, or are you raising the capital, then going and sourcing the deal?
Deal first, then raising the capital. I have mixed feelings on funds. I personally don't think that as someone early in syndication that I would likely be able to create a fund that was very successful, right? I think you need to have a track record and stuff like that when you're setting up a fund. And I think people have, once they do that and they already have these investors, it's easy for them to fill up their fund. And then it's easy to find properties too, because you already have the money in place and you're like, yeah, here, you can show you this bank account that has the $5 million that we would need to raise. So it makes makes the certainty of close higher, and so the brokers like that better. The sellers like it better. Everybody likes that better. I just think that's probably a really high bar for someone early in the game to kind of step up and say, I'm going to create a fund. Because I have that interest in sort of helping veterinarians, in the back of my mind, I have the idea of having, sort of veterinary based funds or fund at some point, where once we have a track record and I've already got, some veterinarians lined up to invest in these deals. So it's starting. And I think that, it's that type of thing that builds momentum, I think, pretty quickly. So yeah, maybe in the future, we might have a fund-based model. But as an investor in other people's deals, I don't actually like investing in a fund. I like to pick, and that's just because I have interest, right? I know enough to be dangerous. Maybe I know enough to say, oh, this deal looks good to me, this one doesn't. With a fund that's kind of those, sort of blind funds, you just put your money in, you trust the sponsor, which is great. If you don't want to know, if you just want to trust that person, you don't want to know anything about the assets that are being purchased, sure, there's nothing wrong with that strategy. I just think you have to know, either as an active or a passive investor, what your strategy is. So that's my reluctance to invest in a fund passively, is maybe why I'm not super keen on creating a fund myself right now.
So there are certainly inherent benefits, right? When you can show up and as you had stated, and verify that you have the cash, not only are you more competitive in the bid process, but deals have a way of funneling their way to you, right? You start to be sought out in the market, but it also comes at a steep cost, right? When you have a fund, you're typically paying interest on, or target interest on, that money from the time it hits the accounts, right? And that creates pressure, right? Velocity of money becomes a major factor. And sometimes that's where, mistakes happen, right? When you're feeling the pressure and you haven't been able to deploy that capital, those deals that, maybe you were a little bit more vigilant in your scrutiny of, you kind of, start to rationalize things a little bit. So I applaud you for doing it the way you're doing it, and you're finding a way to identify the deal. You're raising the capital. Let's talk about what happens next, right? So the deal is now under contract. How are you financing these things? What type of leverage are you seeking? What partners are you going to for this?
It obviously depends on the deal, what financing you're going to have, and I've very quickly gotten quite an education in all the different options, because it's all kind of thrown at you, and it depends on the deal structure. So interestingly, the first deal that we got into, the seller had its own lending group, and they wanted us to use their lending group as part of the sort of stipulations for getting the deal. Again, trying to get a deal. Okay, we'll use your lending group. We put in a clause in the purchase and sale agreement that said, essentially, if you can't perform, we get an extension to try and go, get debt from someone else. So we protected ourselves, but I didn't have a problem using their, as long as the terms are good, then fine. I don't necessarily have a problem using their thing. So in that deal, we were thinking it was going to be bridge debt because it's been sort of undermanaged, and I think that there's a fair bit of capex that we want to do to make it nicer. And so initially, the quotes we saw on bridge debt were better than what they actually turned out to be once we saw term sheets. And so it just so turned out they managed to find us some agency debt through Fannie Mae that had great terms. And I was like, well, yeah, we'll do that, of course. Like that makes a lot of sense. One, because as I'm sure you know, that you need to build a resume in having agency debt to sort of keep getting agency debt, or to make it easier to get agency debt. And that brings up probably another, part to answer your question is, as a new syndicator who doesn't have, millions of dollars sitting in the bank account, you need to bring someone in as a loan guarantor or key principal that has the net worth and liquidity and experience levels to sort of satisfy, especially the agency debt, what they want. And it's outside of agency debt, you probably can get a lot more leeway, but you're going to pay a much higher interest rate, right? So you're essentially going to pay for that risk. So yeah, we brought in a key principal that had that liquidity and net worth, and so it's, people always say it's a team sport, and for sure it is. It's not a thing that could it be done on my own? You know what I mean? Like, maybe it's possible for someone to do it on their own. I don't want to say it's impossible, but there's so many moving parts that it's very, very hard. And it's, maybe you could do it on your own if you had employees, I guess, to do some of the tasks, but it is very helpful to bring in partners that can, there's different roles, right? There's like acquisitions and underwriting, then there's capital raising, then there's asset management. There's sort of those components to the whole syndication deal. And it's very, very hard to wear all those hats.
It certainly is. It's interesting that you found an asset where you were contemplating bridge debt. And again, folks, bridge debt is for, Doc finds a property, it needs a bunch of work. It's not stabilized. Either there's underperforming tenants or there's a fair amount of vacancy, right? It's not cash flowing the way it should. And these bridge lenders, they charge a premium, but they'll come in and essentially give you short-term money. They're the bridge, right, to permanent financing or agency financing. And it's not typical. And you good job on your part to be playing in the bridge world and find agency money pre-stabilization. That's quite an accomplishment there. There's not a lot of that happening.
I don't know that I can take any credit for it. It really was just the lending group, and credit to him. He worked really hard to find it, because and he knew there was obviously incentive, right? Because in the PSA we had that sort of built in where, yes, we'll use your group, your lending group, but if it's not good terms, then we get to go find our own. So they have incentive to have it be, kind of what we want. And so he shopped it out everywhere, and I'm very happy now with with the terms that we have. I think it's great. There's pros and cons to every different type of debt, right? The bridge debt, you said it's short term. It's easy to get out of, right? There's not usually a lot of prepayment penalties, whereas the agency debt there is. So it's, although the interest rate might be lower and things like that, now we have to think about, in terms of exit, when we exit matters, because we have that, potential prepayment penalty. I mentioned we're sort of working through all this because the other deal was a loan assumption. And so then I'm learning about loan assumptions and supplemental debt and all of this. And it's just funny to kind of work through it all and see. It's important. It's another part of that team, right? The lenders, having people that you can go to and say, here's the deal. What do you think? Because you want to have an idea of kind of what to expect from a debt standpoint before you really get it locked up and you maybe put down hard money, because if you don't get that changes the returns dramatically. So it's kind of something you want to have someone you trust to give you that information pretty sort of right off the bat.
Yeah, it profoundly changes the pro forma, right? We're talking about most bridge deals we're seeing up here now between 8 and 10%. Sometimes there's a point or two involved, and stabilized institutional debt, you're down in the 3s and 4s. You're talking about a significant delta there. So are most of the assets that you're targeting underperforming or in need of a facelift now? Are you buying straight stabilized, 95% occupancy, deals, or are you looking for those elbow grease deals?
I think, again, probably, has a lot to do with my construction background, but I think, to me, I really do like the idea of the value add. I think that there's more to be gained there, right? Like the upside would be higher than a stabilized deal. I'm not I'm not against it, right? If it's a good deal and we can get good returns for investors, it doesn't. I'm okay with a stabilized deal, but I think it's I think I probably would still go in there and be like, okay, how can we make this even better? Kind of, I don't know that I would just sit back and say this one's stabilized. I don't have to do anything. So I approach it all with that kind of mentality of how can we make this better? And in those stabilized deals, maybe it's a matter of just amenities, right? You put a nice playground or a fitness center or something like that, something for the tenants just to kind of make it a more desirable asset to live in.
Sure. And those little micro adjustments go a long way, right? Yeah. Yeah. Those little amenities are the things, folks, that will likely distinguish you in your market when folks are researching a place that they want to live, a place they may want to raise their family, right? Having the ability to stand out with those amenities really do win the day when you're in a tougher environment and you really are competing for tenants. So I think we have a pretty good understanding on the deal side. Doc, can you walk us through just a few minutes on the investment side, right? I'm a vet, or I'm someone that's a passive investor. What does your process look like? What can we expect if we want to invest in your fund, or not in your fund, in your syndications? What would that look like for us?
Yeah. So I mean, the process. Well, if you back up to what kind of raise is it, right? So there's sort of two different types that are commonly occur. There's the 506B and 506C. 506B, people talk about it's a sort of that friends and family type of capital raise where you can have sophisticated investors that aren't accredited, up to 35 of them. So you may have friends and family that they may not meet the accredited investor criteria, but they're interested in sort of bettering their lives with what I think is a very safe investment, versus the 506C, which is all accredited investors, but the 506C you can advertise. So there's pros and cons to both. Generally, what it looks like, from my standpoint, is because this first deal, at least, we're doing a 506B. I'm not allowed to advertise it, so it's just I'm reaching out to everyone I know that that I think might be interested in the deal. Again, a lot of them are veterinarians. A lot of us don't have a background in this, so there is a lot of discussion, education. It's some people I'm talking to 2, 3, 4 times before they're comfortable, but I feel like that's just a part of it, right? Like that's how we have to get there. Over time, that part will get easier and easier, but it's a matter of I don't want someone to invest if they're not comfortable. So I strongly believe in the asset class. I strongly believe in these deals. I'm investing my own money in my own deals. So I'm not just trying to sell something. And so it's easy for me to sort of get excited about it and just, be all worked up and this is going to be awesome. But I definitely have to, sort of scale it back and just listen to the questions that they're asking. Everybody has different concerns, right? Some people are very much, they're looking at the upside. Some people are very much looking at the downside. What could possibly go wrong? That kind of thing, where, I've had some people say, I feel like you'll probably outperform on this deal. And it's like, well, so do I, but we can't, that's not how you want to present it, right? Under right, promise and over deliver. I don't want to tell you that we're going to have, a 10% cash on cash return, and then you get a 7% cash on cash rate. It's much better to go the other way. So it's just kind of managing expectations. I don't know. I feel like I do that a lot in my job as a veterinary surgeon, right? I've got to explain a fairly complicated thing to people, surgery on their pet. I've got to explain that in a way that they can understand it and feel comfortable with it. So it's a similar, I think, process in terms of how I go about sort of talking people through it.
And I know you had said you're raising money for specific deals, but do you have any kind of typical guidelines? How long is there a lockup period, right? How long can people expect their cash to be tied up? What do target returns look like? Are there capital gains events at the end of these things, or are you refi cashing out and just paying people back? What does that process look like for you?
So on a general basis, we're thinking like a 3 to 7 year hold, probably more like 3 to 5. We don't really have the intention to sort of refi and kind of keep going from there. It just depends on the deal too. Like you talked about the capital gains events. Most sales are going to have a capital gains event at the end, unless you're not in an opportunity zone. And then you have, sort of those things to think about. And so I guess it depends a little bit on the deal, but in general, I think we're, in that 3 to 5 range. And again, it depends on the debt, because the bridge debt is typically going to be about 3 years. So if you can stabilize that asset and sort of complete your business plan in 3 years, you might be better off at that point just selling, exiting and sort of moving on to the next one. I do have ideas in the future of having some that are just like for my family, where I might do something like that, maybe a smaller property where we go in with some bridge debt, fix it up, and then refinance it to like a HUD loan that's long and low interest rate, and just this is for my kids, right? Like they have a thing that just keeps giving cash flow forever, if they don't want it when I'm gone, they can sell it. But it's just, I think for me, it depends. I feel a lot of people, you'll hear them talk about really getting into a specific niche, and you have, I semi agree with that, I guess. I also believe in being opportunistic. So it's like when I started Lark Capital, I have a business partner in Lark Capital. He's literally just a capital partner. He doesn't even want to have any input on how the business goes, but it allows us to pool our money and be more, sort of effective. So we do that when we started out, and I realized how hard it was to find deals that would work. We started just thinking, okay, well, now we just put a bunch of money in this account. It's just sitting there getting, minimal interest. And so we did some private money lending for some flippers, because that's a quick turnaround on the money, right? So you get your investment back in 3 to 6 months, and you're getting some interest rate on the money through that time. I ended up just through networking, connecting with a group who they used to do multifamily, and they've moved to self-storage, and they were doing a joint venture model. And they said, do you want to be a part? Sure. If it's a good deal, like I'm happy to come in there. And it's a joint venture model. It's a joint venture that is managed a lot like a syndication, in the sense that they mostly take care of it. But it's kind of, I just saw opportunity to put our money to work. And so it's kind of, do I think that I'll be like a self-storage mogul? No, I think multifamily makes more sense to me. I feel like I can affect the value on multifamily more than I can on self-storage. So maybe it's just not as fun. I don't know, but I think just being open to what's out there and educating yourself enough to actually not make, hopefully not a dumb decision, right? Not putting your money someplace that doesn't make any sense. It's funny when you get yourself out there on social media as a capital group, some of the messages and people I've got reaching out for money. Do you invest in this, certain sort of weird thing? No, sorry. Thank you for reaching out, but no, I'm not going to do that. But it's like, I have said this in the rest of my life too. I don't tend to just say no right off the bat. I want to kind of hear what the opportunity is, so I can make my decision. I don't want to miss out on something if it's good.
So a couple of great points there. When we were putting together our subscription booklet, right, for a raise. It was a challenge because you get a lot of advice on these things, right? And there's that mindset of, well, no, you just want to be experts in one little submarket of submarket of submarket, and people get right.
You're an expert on the street.
Right. You know, and then investors get nervous if there's too many different diverse opportunities, and we just felt like no, you know, we've got a really wide berth of expertise. We've been doing this for a long time, and we felt it was very limiting, right? If there were opportunity, like good deals are good deals, and if it made sense, like you said, to deploy some capital in first position at a 50% LTV at 14% with 2 points for, you know, with a minimum of one year and a 6-month payout, you do that deal, right? Like it's just, and I applaud you for that and for doing that, because that's when you're really working for your investors, right? That's when you're driving value there, and people seem to be timid in that regard. But good for you in doing that, because there is a lot of different money to be made in different places. You don't want to be disorganized, and you don't want to be chasing, different rabbit holes, but you certainly want to be able to fill voids on your terms, right, when the opportunities present themselves. So you mentioned opportunity zones. Do you have a QOF set up? Are you doing OZ stuff or no?
So I technically, yes, I am in a one opportunity zone fund. It's through one of my business partners. We were introduced actually through our mutual mentor, and probably, I think it's been over a year now, and really we just kind of, we talk a lot. We hit it off, and he was working on a development project in an opportunity zone, a student housing development project. And when I learned about opportunity zones and sort of the tax benefits to that, I had thought, I really liked the idea that I could pull some money out of stocks, get rid of some of that capital gains there, and then exit at the end with no capital gains. And I don't mind holding for 10 years. I think a lot of people don't like that idea, but I didn't, it doesn't really bother me. And so initially the discussion was, I want to invest in your deal. That deal got pushed back because of COVID quite a bit. And so over the time, and I actually am very interested in development. Again, that construction background, I think is very, so we kept talking, and he was like, do you want to be a part of this? Do you want to, maybe raise some capital and be in the deal for a small percentage? And I was like, yes. I don't, again, it's that opportunistic thing. Like, it's like, I don't even really care about what I'm getting for fees or percentages or whatever. Like, I'm actually just very interested in development. So here's an opportunity for me to learn something new and also maybe make a little bit of money from it. So, but it's like the money wasn't the driving force on that. It's not really, it's more about, if I can learn how to do development, it's like another, putting another tool in my tool belt.
Yeah, so we were really bullish on OZs. We spent a lot of time on them. We've got a few QOFs, and we've got some holdings in different states. But unfortunately here, the New York decoupled from the federal benefit, and
California too. California doesn't recognize them.
Like, really, like it was such a great program, and we're now seeing money funnel out of New York into surrounding states, into the areas that need it the most, because they decoupled from the benefit. So again, for you, I figured I'd touch on it. Having the construction background, there's a lot of neat things you can do with the QOFs if you do have a construction background. So again, right on the mark. Good for you. We're getting a little tight on time. I've got a couple of more I just wanted to round out on. Are you targeting program-based tenants and assets, or are you targeting market rents for the most part in your portfolio?
Currently not program-based, more market rent. Again, another thing I learned with all of this, sort of lending, investigating, is you get a savings on interest rates to some level if you keep the rent. It's not it's technically not, low income housing or program based housing, but if you keep the rents below a certain level, you can still get a reduction on your interest rate. So that's something that I think can actually be valuable in some of these markets and some of these sort of developing markets, that whether they're opportunity zone or not. So I think I wouldn't be against it, but I don't know it. I'm not familiar with, how that works and how to manage those. So it would be a matter of, again, like learning another thing or finding a property management group that specializes in that.
Got it. Doc, I think what you're doing is great. I'm a big believer in, advocating for and promoting the financial literacy component, something that, again, is so obvious, yet so far into so many folks. It's what we're weaving it into our institute.
Absolutely.
That we're building out here is, when we really sat and talked about it in book club, it was like, we know these things, but nobody really teaches you this. And certainly for the newbies that come on board, we wanted to offer just some sort of background so folks understood some of those core principles. We think it's really important in developing the career and in happiness, in getting to financial freedom. So,
Sure.
I think what you're doing is outstanding. How do folks find you? What's the best way to find you, Doc?
They can email me. It's jason@larkcapital.com. I'm also on probably Instagram, as far as social media, is the one I use the most, and it's just @Lark Capital. So they're easy to find. It shouldn't be, but if anyone wants to reach out, please do. I always enjoy talking about this stuff, and I think especially to young people. I train interns and residents, and I'm sure they're sick of me talking about this stuff, but I'm like, listen, you guys, when you leave here, you're gonna be used to not making a lot of money, and then all of a sudden you're gonna make a lot of money. Pretend you're still not making a lot of money for like 2 years, and you can change your life for the rest of your life. You're in a position at a young age to sort of have a vastly increased income, and you can make it work for you. So I think it's just, it's awesome that you're implementing that stuff at your company, and I guess I'm sort of trying to do that with the people I work with too. But I think, once you realize how good it is, it's hard to stop kind of being excited about it and talking about it.
It sure is. Well, we really appreciate the time today, folks. He's the Doc, Jason Ballara, CEO over at Lark Capital Group. Best of luck, man. If we can ever be an asset, you know how to find us, and appreciate the time today.
Yeah, I appreciate you. Thanks for having me on, James. Thanks, Becca.
Absolutely. Stay safe.
Thank you. You too.
Thanks, everyone.